Dear guests, welcome to our panel discussion this afternoon. Thanks for taking the time. The topic today is opportunities and risks of indexing. And I want to start by quickly introducing the panel. All the way to your right is Urs von Gunten. He has been an index fund manager for 28 years. He began his career as a securities trader at the Basel Stock Exchange. And in 1995, he actually joined my team at the time at SBC, managing the SBC 100 index fund. So Urs and I go back about 30 years. He's now moved from UBS, where he's been responsible for the index business, to Gunten Vaudoise, and is building up their index fund investments. Then next to Urs is Robert Edwards. He's a director of product management for EMEA and ESG indexes in the Morningstar index team based in London. He holds a bachelor degree in finance from Ohio University in Athens and is a CFA. Then next to Robert is Dr. Christian Bahr. He's the head of the index services at SIX. SIX is known for the Swiss indices, so for SMI, SPI, also for the whole bond index family and SARON, but also for the Spanish IBEX, for example. He also chairs the Index Commission of SIX, holds a master's degree and a PhD from the University of Hanover. Last but not least, just next to me is Marcel Wagner. He's in the product specialist index solution team within the asset management of ZKB. He's completed his studies in St. Gallen as a Litzhöck, holds the CAA designation from ATSEC and the KAYA. So the topic today is indexing, and I want to start by asking all of you maybe to just quickly give me your feedback. Why are index funds better than active funds? Is it just costs that kill the performance of active managers, or are there other systematic factors as well? Maybe, Urs, you want to kick it off?
Asking me is maybe, of course, that's my favorite investment style, but I will not compare it to better or worse. It's a different investment style. And I think to invest in a large-scale capital market world, it is very appropriate to do a good trade-off in between. Sorry, I can't hear you. Thank you very much for the comment. So now it works. Thank you. Technology is kind of. I think it's not better or worse. It's a different investment style. I love it, of course. I'm doing that for nearly 30 years. I've been involved since 88, 89, when the first index product was launched in Switzerland. And what I in particular like, there is no assumption, there is only data-driven, and the results are to be explained easily, because either you've done it great or you don't. And then technically you can explain, and so therefore it's a very appropriate mainstream investment vehicle to move big assets. That's maybe what I would like to say.
Yeah.
My colleagues have, of course.
Yeah, maybe if I can add, I mean, first of all, the argument of low fees is really valid, but in the end you have a constant strategy, so you have no active PM shifting around his views. Then it is a transparent style you pursue, and of course you have a broad diversification. But I think in the end what's really key, an index PM, as Urs is, they are always fully invested. So if you have corporate actions, you do cash equitization, you have no market timing, that's really different to active funds, right, Urs?
Correct.
Yeah. And I'll jump in. I first want to say thank you to my people up here to sinking down to my level and speaking English with me today, so thank you for that. But you know, we talked about it a little bit, but I think transparency is the number one thing. I think going back to kind of how Morningstar actually got started was, you know, bringing transparency to markets. And I think the best thing for investors is to have really transparent investments, and that's my favorite thing about index investing.
Well, I think the other element is that, I mean, indices, it's very hard to beat an index, beat a market. And it's the cost of index funds is one element, but I think active managers are not consistently in a position to outperform, and so why invest into that if they're always lagging behind the market? So I think that's another key element. Go for the index fund.
Yeah, but in the end, it's kind of a free rider game as well. As long as we have enough active managers, we can profit from them as well, right?
Yeah, exactly. I agree.
Well, you need both. You need both, of course.
You both, yeah. To have efficient markets. Yeah.
Price formation.
I love the active guys. They provide information and the proof that indexing is a good style. But without them, without them, we couldn't prove it because other than that, there is not enough information in the whole universe anymore. Why should you research on financial data? And if it's then just volume driven, so who determines the price? Somehow, that's the at the end. So I'm happy they are there. As good as they do, as bad for us, but the bank earns more fees and the client is happy, has more outperformance. But if it goes the other way, of course you can shift easily to a very solid and cost-efficient approach to be invested into the market. As we discussed it before, there is only the market risk you're trading off. It's not an individual stock risk you're going into it, but the market risk. Yeah, if you invest somewhere and you're out of cash, of course there is always a risk attached to it, but not a bet like you can see in an active universe where you have really convictions and over the statistical data in the long run. I would say you're better in calculating, but if you go to compare over 10 years, you see the results, and that there is certainly always a good space for indexing in these phases. Excuse me, I'm too long.
No. I just wanted to wrap that up with a number. So we actually do this report called the Active Passive Barometer, where we measured that. So at least, it's different in all asset classes, but at least in the equity space, the 10-year success rate, basically, do active funds do better than kind of an average of passive funds? It's only 17%. So I think we have a lot of empirical evidence that, at least in certain asset classes, that kind of the investor experience is better in passive funds.
Maybe I can, when you say 17% in asset classes, I mean, this is a pretty bad statistics if that would be true across the board. Is it really like that? I mean, what are areas where there is a massive outperformance of the index fund, and where are the pockets where an active manager still can add value? In the sense, what are sensible criteria for indices? How many constituents do you need? How big does the market have to be so that it actually is very likely that an index fund outperforms ultimately?
I mean, I would start on the asset class itself. Obviously, some asset classes are much more liquid. Equity, whenever you think about indices, is mostly equity. But as soon as you move into fixed income, already the challenge comes up, where do these bonds trade and when do they trade? It becomes less liquid, and of course, you can build an index on pretty much everything. You have some data, you have a spreadsheet. But then if my colleagues want to build an index fund on it, it becomes a bit more challenging because you need to trade those products. And for example, fixed income is the first hurdle. If you go into real estate, it's even more difficult unless you have real estate funds. So I think not every market itself, even on the equity side, some illiquid markets, small caps, may not be the most easy to track in an index. So I think there might be opportunities for active investors as well in those markets, in my opinion.
Yeah, maybe from a portfolio management point of view, an index needs to be investable. Sounds really basic, but that's key, investability. And you need liquidity. So in the end, as an index PM, you always want to trade on close. But if the closing price of the index is not liquid, so it's hard to track an index. So the best example in Switzerland is a listed real estate, the SWIT index. So we all have index funds on that index, but it's really a challenge to trade those listed index funds because the primary liquidity is not that high.
I would just say from an index provider standpoint, I mean, one thing that we do kind of behind the curtain is always test investment capacity. So we are actually trying to think about who's the end users for these products, because we want to look at capacity and over concentration. I'll give a good example. We have a Morningstar Denmark index. It's uncapped. So right now, if you look at it, and it's a good benchmark to see what's happening in the market, but it's I think 62% one stock, right, Novo. So it's you have to look at over concentration as well.
And I think transparency is important. Like my colleague said already, you can index everything, but if you have these constraints then after with liquidity, there is of course the question, there you need to allocate a tracking error budget who is not only the indexing, and then I think there is the active opportunity that you also as investor and maybe prefer than something, okay, we do it then semi-active, active, because with a only liquidity-driven restriction to replicate an index properly, what is then the sense to do that, you know? But if it's only for low-cost portfolio management, not adding in the extra effort, you're then trying to buy in active management, so to speak, for free for an index replication, and that is liquidity and feasibility factor is very decisive to say it's indexing. Nearly, if you only take, give me an example, the biggest company in Switzerland, you take a food index, and with one company, you can do that. That's liquid, and that's everything, but maybe not really making any purpose or sense to the audience. But if you love that, this can be done very easily because it's liquid, has all the parameters, easy to calculate. That's SIX or Morningstar index providers, and for us as PMs, very easy to replicate to nearly every size. You know, so that's about the background, client demand, and what tracking error or how you define indexing. Is it a tracking error of 2%, like it was 30 years ago, or is it a tracking error of 1 basis point, and then it's different? That's sorry here.
I mean, you also need to look at the use case of the client in the end. If it's an institutional investors, they go in with big sizes, the index needs to be much more liquid than if it's a small structured product on the index, for example. Or if it's derivative trading, you can only go for the most liquid stocks. Otherwise, derivative trading doesn't make sense. So there are many use cases that can happen in the indexing space where liquidity could be different.
Yeah, but I think as an active manager, you are in some places safe from us active guys when it comes to private equity, to unlisted segments. Of course, if you're in the high yield space, I mean, theoretically you can index high yield, but in practice, it's really hard to do that because we always have to invest full basket to trade on close. As an active manager, you can take time. So there are some spots where you cannot really index a market properly.
Based on, sorry. No, I was just going to say, based on the title, the opportunities, I mean, I think if I'm looking 10 years, 20 years down the line, I think private markets and digital assets are the two areas that look like a really interesting opportunity. I think we'd agree you can't do it now.
If you have the blockchain in place.
Yes,
Yeah.
I just wanted to say to the audience, if you have any questions, don't wait for the end. Just when there's a topic that you're really interested in or you want to follow up on something that has been said, just quickly raise your hand. We've got a microphone and you can ask your questions. Maybe if we can stay a little longer on the topic of sensible indices. So you actually brought a much better example. I would have mentioned the SMI. Why would I want to put half of my money in 3 stocks? But 60% in Novo Nordisk beats that. But the other thing that I was always wondering, why is it intelligent if you market cap weight something in the bond space? Why would you want to put most of your money where the country actually issues most of its debt? So Japan, as an example, is very big in all the bond indices. Is that really how you want to allocate your money if you index fixed income?
That's becoming somehow a market standard. Someone started with that, and all investors says, "Oh, great idea, let's go with it." But I'm totally on your side. Investors should also think what they buy. And if they say, "Oh, I don't want to put all my money into Japan and the US because they're the biggest debtors in the world," I think they should ask for other indices. And all the index providers, we both are standing here next to each other. We're happy to build an index and reduce the weights allocated differently. But I think it needs to come from the investors. If they all just follow the big names, the existing standards, nothing will change.
Yeah, I think conceptually it's kind of weird as opposed to market cap weighting on the equity side. So everyone thinks it's kind of strange to have that higher weight in Japan. But nevertheless, if you have global bond index funds, they are really hard to beat for an active manager. So I see that point, but in practice it's still not that easy to beat.
I mean, the largest holdings, if you do look at those indexes, they're from, like a global bond, US, Japan, places where they have very high credit ratings. So I think you are getting very good quality bonds in there. And I probably shouldn't say this as an index provider, but that same study that showed how well equity active managers are doing, they're doing much better on the fixed income side. I think especially the last year or so, being able to kind of play with the duration exposure and things like that.
I would also stress it's client-driven. It means what's demanded, and maybe indexing. How in the old days they called it passive, so you hang around the whole day long doing nothing. That's exactly the opposite, because you're busy to get all the details in data and to provide that. But as it has this perception of being just passive, once it's established, and it means we all know there in the 90s when this got very popular in Europe for different reasons, in particular in the Swiss audience, then there have been 2 or 3 standards, and it worked for 35 years quite excellent, and the performance is relative, or the main performance is relative to 2, 3, 4 standard indices. And then, of course, you don't want to really deviate from that. You would compromise your track record, or you need to justify to your supervisory boards and bodies why I'm changing it, and you could have suddenly a higher tracking error you need to explain. That's just an human behavior that in indexing, that's correct. Everybody does it, so I continue to follow. And that's maybe from standard 30 years ago, where everything in equity, where I'm home, it means everything below 2% tracking error was indexing, and there you couldn't buy anything more than 10%. So this is not indexing from today's perspective, but it went from a very active part. Now active is 2% tracking error. No, right? If you have more tracking error than active, you're already a crazy guy or in private equity hedge fund space. But this is also this definition. And then you go now from a level for, let's say, very creative indexing, as you had no choice. There is 2 or 3 indices. Now you have 300, 500, 1,000 for the same subject. And then this movement goes very slowly, that you say open up and say, okay, there is now, okay, this is now cheering also my colleague from SIX, but there is in Swiss equity space, based on the Swiss equity universe, there is no better index than the SPI, but maybe in a global context, there is also an alternative approach who respects better, but if you're going to go on capitalization weighted only, then there is the standard still the same like 30 years ago. But of course, this all evolves. But the critical thing also to be said is data costs and all that gets so intense over time, also to provide all these details and deviations, derivative indices from the standard indices, that there is also a component that I think that's really difficult for all of us to say the cost of production is somehow higher than it is seen in the market. And what, for example, in Europe gets forgotten many times is the risk of big assets has a price. That is, if you do a detail level in an index who has a 5% weight in an index and you miss a corporate action, per se, in percentage, it's a very small thing, but the overall huge asset base can trigger a very high sum of profit or loss. What's then random? Profit is possible, nobody cares, but if it's a loss, of course, then it's critical for everybody. And this is also something to be considered why change is then not, you have no budget for new ideas. You're just running with low costs the current operation as effective and industrialized as possible, and that is maybe then also hindering a little bit of innovation for new indices. Sorry, too long. Excuse me.
It's okay.
Well, thank you for pointing out the SPI. I much appreciate that. Just wanted to mention. I think you brought up an important point. I think there's also a lot of indices being created on the same topic, and of course that's maybe one of the things. It gets a bit more difficult these days for investors to choose and pick which one to use, and of course some of them have the same name, they sound similar, in the end they're doing the same thing but just a different brand. So I think that's something that is probably also the industry doing, and I think it's also then the needs, the additional information that clients need to distinguish which strategy to pick from. It's not just the index, you need maybe additional information on risk statistics, ESG scores. You probably have a screening on top of the index portfolio if some of the instruments are sanctions, for example. This is all additional information which are now more relevant than, let's say, 5 years ago.
Yeah, I think that's one of the biggest risks you have today, that you have chosen the wrong index. That you have a label and you expect something, but inside in the index is completely a different story. That's really nowadays, I think, a challenge for the investor to select the right index and then the right index fund or ETF. Yeah.
I've actually been using thematic indices as that example lately, because we've done some research and there was a good panel on thematics earlier, but even things that should have similar constituents have very high active share from each other. AI index, it's crazy how different some of the actual portfolio holdings are with the same name.
Maybe this proliferation of indices comes from the fact that it's a very lucrative field of business. I mean, if you look at the last 15, 20 years, all of the growth has been in index funds. I think most of the new money goes into index funds, and there's even active shifting out of it. Can you give us an idea for different markets where you know about the statistics, what's the ratio between passive and active money? So if we talk about Swiss equities, Swiss bonds, US equities, do you have a feel and do you know a little bit the ratio, how much of the money in certain markets is indexed?
We've done some studies on this, so I can say it definitely differs per market. Last year was the first year, at least in the US, where passive surpassed active in terms of overall assets, but very different for the rest of the world. I think it was more 3-to-1 for the rest of the world, active versus passive. And you know, it gets complicated looking at the regions with cross-border sales and things like that, but I would say US definitely dominates, and I think there's some reasons why, but the rest of the world, it seems like it's closer 3-to-1 from at least the research that Morningstar has.
Christian, you agree? For Swiss, let's say the Swiss market is
Swiss
close
equity, if you talk about the top 20 stocks like the SMI, it's the institutional investors, they always go passive. I think you look at pension funds, you can look that up in the annual reports. If they do something on the top 20, it's mostly passive. And then what you see is also on the mid-cap side, so stocks number 21 till 50 till 60. This is where a lot of mid-cap funds are playing. They have a decent amount of assets, but still I think overall the trend is towards passive. Investing passively into the whole equity market is something that we see.
And what's the ratio here? 20% in Switzerland for Swiss equities?
For over Swiss equities, institutionals, I think that's probably something we can't really estimate because you don't see the active share very often. I see the passive share a lot, and I see it's tremendously increasing, at least on the high liquid stocks that nobody is trying to do active on the top 20 stocks anymore.
But I think those 50% in the US, so half the market is passive. I remember like 10 years ago, everyone was saying if we reach that point, then active is attractive again. So yeah.
Well, thinking about this ratio and how it's changed, there's obviously always, whenever there's something getting a little bit crazy in the markets and there is certain stocks are driven up and the Magna 7 or whatever it is, then there's always a discussion that this is a factor of indices because the big institutional money just simply has to buy what's gone up. And so you basically inflate the bubble even more, because the same people have to always keep on buying the stocks that have gone up. Is that actually something borne out? Is there research on this where you can say more and more a drive towards indexing actually inflates bubbles or creates bubbles in the first place?
I have no research, but I don't think it's true. If you're invested in indexing, if it's going up or down, it doesn't matter to you. You're invested according to the index. The only thing is, if you do index changes or big events, let's say without any dedication, let's say fairly, you run it over the machine. You know, he says at the index change close, relative, that's perfect. Everybody only thinks relative, but absolute is a disaster because you accumulate the amount of shares or the volume you on average has to one single point. So naturally, by simple amount of shares you buy or sell, you trigger up or down then the market, and giving you false information has nothing to do with the pricing of a stock. It's just volume driven, and this capacity is many times tracked. So there, for example, to go from really indexing without any brain involved, executing by technology only, to say, okay, maybe a relative approach with big changes, as in the SIX universe, it's done already very successfully. You flatten over the day, accepting that it's for any investor better to not waste too much value, because relative, if it's 10% down and 10% up, you're relative perfect. But if you could do that on average over the day and flatten that impact, you're relatively deviating a little bit, but on absolute terms, you made or saved money and you spend less money than into the close. That is maybe the space of where you can reconcile a little bit to common sense. What we've done in Active at your time, you know, that we really focus also on trade the flow in indexing, you know. But you need to therefore have the products, the understanding of the audience and the clients in particular, that you remain within your risk budgets given. That's key. You have very tight risk budget tracking error within these index products, but that you can use to the best interest of the client. That needs to be the priority. And then I think the bubble risk is from volume driven going down. Yeah.
Yeah, but I think it's fair to argue that the market cap weighted index is a soft version of a momentum strategy. I mean, as Novo Nordisk, it gradually moved up the weight, or maybe Nvidia in the US, and the opposite with Credit Suisse in the SMI, it gradually moved down. Is that good or bad? But I think it's a soft version of a momentum strategy. That's how the market works, right?
Definitely good explanation, but I would say it's also the investor who needs to choose what to do. Yeah. If they don't like this momentum strategy, they need to act. But if all institutional investors just follow the crowd, they should not complain afterwards that they're now in a momentum strategy.
I mean, as you said, I think I agree with your analysis of the pension fund world, and that's probably the biggest institutional money in most markets, and they are consultant driven. And the consultants care about the fees, and so more and more money goes into indexing. And so there will be, in my view, somewhere a point where markets become inefficient. It doesn't necessarily have to be a bubble, but if nobody thinks about what a stock is worth or what a company is worth before he buys it, and he simply buys it because it's in the index, and he buys more of it because there's more in the index, somehow capital allocation becomes inefficient.
Wouldn't that be an opportunity for active investors? Because if markets become inefficient, that's really a sign, oh, we have to do something about it. There is money to be made. Because it's not going always going up, it's also going down. Someone being excluded from index means you expect the stock to go down. So that would be another opportunity for an active manager to go short. I agree.
We need the active managers in order that indexing works. We need them, for the price discovery.
I really think if there is no information transparency in the market, so without the active, you're all dead, because then the index is, then you take only number as value, number of shares as value. How would you otherwise price a value? If nobody does any research, then the whole concept becomes obsolete, you know, and that is, I don't think. Therefore, we need the active guys. If they're doing better, we have better prices. But if not, then we get more allocation to indexing. And so this will then incentivize the real strong active analysis, maybe active. These days, more hedge fund and private equity and whatever. In the 90s, this was all within the market. You know, the regulation and everything did also his impact on that. But at the end, yes, I need active at any time. Fight every day. I want with them, but without them, indexing is not possible anymore, right? That this input factor of valuation to calculate index weight we need, and otherwise we count number of shares without any values, and that is certainly not a good thing for all investors and pension plan schemes to have a performance here.
And I would argue you can. Totally agree.
Sorry.
No. And I think indexers can play a bit of a role in that. I mean, we have several indexes that actually factor in price or fair value. So we are actually kind of systematically buying undervalued stocks. So I think there is, you still have to do the research and have someone to do the research, of course, but I think you can also play that back into the passive space a bit if you're looking for kind of value plays.
And that's one reason why there are so many indices out, because they try to replicate some of the active strategies.
Right.
Factor indices, for example, or growth stocks, value stock strategies. So this is available for indexing, but of course it's not the majority of the investments. The majority is going for plain vanilla market cap.
Those 50% passive in the US, is that pure market cap weighted or including strategy indices?
All passive. Thematics, everything is in there, right?
Because thematics is for price discovery as well, right? It's a wrapped active strategy.
Yeah. There's I don't know how much longer we have, but we could probably go on an hour on whether that's active or passive, I think.
There's a question in the audience.
Oh, sure.
Thank you. Questions, thoughts on these indexes using index options to create caps and floors? A lot of innovation in the United States in that area. Just wondering if you have opinions on indexes using options. Thank you.
I think you're probably referring to that some of the elements that were used in the structured products are now moved into the index itself. I think that the answer is transparency again. If it's transparent for the investor that the index considers options to protect or to provide upside, I think it's probably a good thing to do. But if it's done to hide something in the financial product that, if we just track the index, we don't do anything crazy, fancy, complex, then it's probably not the right thing to do. And as long as I know, some regulators are also looking at that they don't want some of those financial derivatives being merged into the index and not being fully available anymore, visible to the end investors.
Yeah, I think it goes back to complexity. I think they are quite complex. If you, like me, and you're kind of a geek and you'll pick up the index rule books to these things, they're very complex. So I would say, again, they're for a very specific audience. So I don't think they should be used that broadly, because I think requires a very sophisticated investor to understand how and what risks they have. So I would say, use with caution, I would say, for specific audiences.
I like clear index approach and no mixing together stuff. If you want to hedge it or whatever, you can do this separate. But the index product himself should be as clean as possible for transparency reason, for the fair assessment of any client. So should remain clear. Either you do indexing or something different. If you want to do structures or hedge fund solution, do that, no problem. But you can use as a base, but not mixing together. That I think is really a bad thing. Bad thing in terms of, for the investor who believes and trusts this is an index product, you can clearly follow and understand fully, even if you have no PhD in physics or whatever. What I like, therefore,
We have another question.
How do you foresee the risks in security lendings and this stuff, which some index funds do, some don't? How do you perceive this risk? Thank you.
Which risk?
Securities lending.
the securities
lending.
Some do, some don't.
Yeah, I think in the Swiss institutional market, it's quite common that you have index funds without securities lending. And then you have, in addition, funds with, and so the investor can choose. And if you do it, of course, you have to do it properly, secured, collateralized and everything. Then you get some extra money. This was especially attractive during negative interest rates on the fixed income side. Is there a big demand? Yeah, some clients want it, some not. So you can have both. But the risk, I think you can manage them, of course. Yeah, it's collateralized.
It's less risky if you don't do it.
I think in the 90s it was a normal thing. If you invest into equities, you have certain risk, but the trade-off for security lending was quite nice, and some added value to poor index performance liked. And then you got in the early 2000s, all the crisis. Suddenly the audience also realized there is risk attached to it, counterparty risk and all these things. and then somehow it became not liked anymore. So I think the old providers, they still had now this old funds with SEC lending, and some people or some clients still like it. But I think barely since 2008, I rarely seen a new fund being raised with SEC lending. It's just also the business is not that interesting anymore to run Swiss equities. I would say it's really these little small stocks, right? Where the amount is too small for the risk, and the big ones, there is nothing to be won. So just skip this risk. That is my interpretation, how I've seen it evolving, and there it's a preference. If you have to, I would not do it these days anymore myself, but in the 90s it was a normal sense, as all the parameters have been larger, to be also using that with less impact on the detail level. No, that's...
Okay. Just another question in terms of, or going into the direction of the risk. Is there any difference in the package, in the sense if you have an index fund or an ETF? Or does it not really matter?
I mean, as an index fund guy, I say with an index fund you always have best execution, because you place a trade, and our PMs do it at NAV, and you don't have to care about, is the spread right, is the price too high, too low? But if you trade intraday, then you have to check the spread. Is it too wide? Do I have a premium, a discount to the INF? It's convenient, you can trade right now, but you don't know if the price you see on screen, is it fair? And with index funds, you have the guarantee that you have kind of best execution, you get the NAV at market close values. That's not from an index fund perspective.
I've done all. So I produced normal funds, retail funds, institutional funds, ETFs. If it's the same benchmark or segregated mandates, that's the same. It's just another umbrella. And you as a client need to decide, do I want this advantage to trade at any moment? There is always this big, like my colleague said, all to maintain the secondary market trading with APs and all that. That's nice if you like that, but how many investors I've seen in this 30 years of ETFs who decided 5 minutes ago they need to sell or buy 50 million in whatever. So that's a little bit the choice you have. If you love this on your iPhone app or whatever phone you have, I buy 2 SMI fund units now and then sell it after lunch and then buy it again, and you make some money. Just do it, then it's great. But for a long-term investment, then you can also pick the retail share class from an institutional fund. What's mostly, I think really mostly it's available. And then as a retail investor like me and many others, you're happy because you don't care for this interim solution. But that's a fair personal choice to do. We are restricted, so I cannot even buy my ETFs. Or in the new role we don't have it. But so with Insti funds, I'm just perfect. And but that's a personal choice, and both obviously is a demand. So happy as an index provider to provide whatever umbrella you like.
I mean, coming from SIX, maybe to add, the ETF has the advantage that there's more visibility because it's traded at a stock exchange. So I think that's one aspect. You have the marketing aspect has been reported. There's some trades happening. So that is not what you see in index fund. I think so the transparency, the visibility is much higher there.
I mean, to support that, I trade ETF myself as well for my personal account. So I love ETFs. But if you have really a large trade, then everyone does primary trades with ETFs, and that's then the same as with the index fund. So it's more like for smaller trades like I do.
I would just add, it's slightly off topic, but what our research shows is that investors are really bad at timing. Yeah. Either way, basically, they usually always have negative investor returns. But I think this could spur a good research paper because actually the returns are better from an active fund in terms of timing. Mm-hmm. But we should probably research that with ETF versus a passive implementation, because it just seems like on the passive side, investors are poor with their timing.
Mm. Okay. So we're sort of approaching the end of our time. Is there another question from the audience for the panel? If not, maybe I can ask my last question. It's where is indexing and index construction going? I mean, now we have market cap indices, we have thematic indices. What's the new frontier in indexing? What you're working on if you create new indices?
Okay, I'll start first. Well, traditionally SIX was running indices for the Swiss Stock Exchange, Spanish Stock Exchange. Well, we're going to grow out and create some global indices because clients are asking for it. So global equity, which is good to create a new value proposition and to serve our clients better. But long term, I think asking you a question about more what's the other trend is. There's a lot of regulation on sustainability, ESG, if you like it or not. It's just going to happen, and it will regulate financial products, it will regulate indices. So that's something that simply needs to be done. And then, of course, we always have these trends of thematic ideas, thematic investment, active or passive in an index. I think this will always continue. That will be the next theme will come up. Now it's AI. Maybe next year's get AI in the cloud or whatever. So I think these trends will also happen. And then we don't know what happens with the crypto world. Maybe it will materialize or it will be just go away.
Another question about what do you prefer, physical or synthetic replicas? Physical or synthetic replica, what do you prefer? Where do you think makes sense? Thank you.
I think if you want to invest into equities, you want it physical, because if you're going to, I know this is a very interesting question and many times discussed, but if I want to have an equity index, I want to have equity and as little as possible, some cash, okay, inevitable, because you have accruals of withholding tax and whatever, but I avoid as much as possible synthetics. Some futures are required for standard capitalized investments to invest the accruals, but even there you can consider what's cheaper. It's a derivative at the end, the future, and therefore you need to realize that. And if there is a market distraction, you have also this is going. So whenever you can in equity indexing, do equity only as much as you can. That would be my conviction, or what I like. You know. And
I think the market is chosen. In the end, you only do physical replication, because when you get the swap from a Delta One desk, they have to hedge themselves. And if you have to hedge yourself, you need to invest properly. And they invest in the same stocks as well. So you have someone investing in the stocks, giving you the swap, and then you have the exposure. You can cut that out and you have it outright in the fund. So you have the pure stuff inside the fund. So it doesn't make sense to hold a swap in a fund in our space. However, there's one case: if you want to invest in US stocks, you want to have like a better withholding tax treatment, then it makes sometimes sense to use a synthetic product. That's from my point of view an exception. Yeah.
But that's a regulation or driven, so
that's tax arbitrage. Yeah.
It's tax arbitrage, and because the US has an old contract with Ireland, or so this example is the most used one. You just trade the best for your client, but it's just purely an old agreement they've done to have an advantage for Ireland. Many, even I think 100 years ago, and so this can be used. But without this regulation, yeah, you said it. And for the future. Well, really, this total thematic thing, like my colleague said, it means if this going really in sustainable space and the regulation triggers in, then I think there is, I think, really a huge opportunity to create, notice, there's somehow data, I factor this carbon tilt in and out and climate aware and CO2. But to create really something with analytics, and a few guys I think are in the audience in this field, to get their standards and really reliable standards for anybody, measurable, that you can recreate an index. And the index providers, they do there a great job, that you have some really factors. They don't change every day by self-declared whatever. And then you have a reliable approach. But also there, it's a choice, and if it's dominated by regulation, I don't like it too much, because burn in this case is always not very practical, not very, let's say, client-oriented. But the industry is at least therefore forced to find good solutions for the audience and give some metrics. They are reliable and transparent. And that is, but this is, I think, depending in the US, you see opposite movements where they want to rewind, or the legislation body is starting to say no, there cannot be a central decision from investment managers just to go all green. It needs the agreement of the client, because at the end it's the owner of the money who should decide which way, to what extent he goes, and if he's willing to spare $200 a month for his retention plan at the time he gets retired or not, it means that's at the end the ultimate big money where it's invested from all of us, you know. Sorry, too long again.
So, no, I think we've sort of exceeded our time limit a little bit, but I would like to thank the audience for the interest. Thanks for coming, and especially the panelists for the interesting contributions. Have a nice day.
Thank you.